Awesome. Got the YouTube going as well as the TikTok. I'm just going to post on the general discussion, letting people know that I am now on. Let's go right here. Perfect. All right. So we're going to wait a few moments here while we have some people join in. Got some interesting topics that we're going to talk about for today. First, looking at the $2.3 trillion that they are now injecting into the small businesses. Yet again, lots of money printing here. And BTC is not looking bad. BNB is the only real opportunity here for a long, just for a quick little trade in my personal opinion. And I'm just going to put this trade plan here just so I have a good understanding of where I could see this follow through, and I know what my risk parameters are. All right, so I think we're going to get started with the recording now. Recorder. All right. And like always, if you have any questions, I will answer all of them at the end of the video. All right. All right, I think we're gonna get started here. Don't have a whole lot of people, but that's okay. It'll be a pretty interesting video, in my opinion. All right. Hello traders, welcome to another global macro update. We got a very interesting video in my opinion for today. We got a lot of stuff to go over, so let's get right into it here. If you have any questions on our live, just put them in the comment section below on YouTube or TikTok and we'll be sure to answer them. So first things first, some important news of the day. Federal Reserve unveils details of $2.3 trillion in programs to help support the economy. The Fed plan would inject another $2.3 trillion into businesses and revenue-pinched governments. And moments earlier, the government reported that 6.6 million new jobless claims were filed last week. We'll look at that in the Fred website very shortly. But I just want to go over just what's been going down recently, because it's really easy to get lost in the numbers. So this is a quick kind of explanation of what's been happening over the last month. Not everything is said, but just in short, we're kind of going to cover what's been going on here. Mr. Powell said that the Fed would put its emergency tools away when the economy is well on its way back to recovery. So yeah, they're in no shape to stop printing money, stop stimulus. So they're going to continue to do this. This is not the last one. Like we said last time, there's going to be more and more stimulus coming into the market. The central bank's last month cut its short-term benchmark rate to 0, and it has purchased more than $1 trillion in treasury and mortgage-backed securities in a few weeks to stabilize core pillars of the U.S. and global financial markets. A record of 7.5 million Americans were receiving unemployment benefits at the end of March, the Labor Department reported Thursday. Another 6.6 million has submitted claims in the week ending April 4th. And we can see that right here. So this is starting from mid-February. This is a weekly initial claims data set from the Fed website here. This is from the Federal Reserve, and it shows the data really in real time on a weekly basis. How many people are actually submitting unemployment claims? And we can see back in February 15th, there was 215,000. And if we even date it back, it's around that, right? That's we see in February 15th, 215,000, February 22nd, 220, February 29th, 217, and this is new, right? This is the new initial unemployment claims that are coming in. It's not like it's adding on to the previous one. So it's not going to count anyone from here. This is a brand new, fresh 217,000 people on February 29th. And then we see March 7th, 211. And then this is where that jump came in from 282,000 on March 14th. The next week, it jumped to 3.3 million. The week after that, it jumped to 6.9 almost. And now we got an additional 6.6. This isn't added up. So just in the 2 weeks, we're seeing like over 12 million people file for unemployment claims. And a week before that, it's 3. Right? It's unbelievable. Just the amount of people who are filing for unemployment claims is substantial. And we know the stock market is going up. But how in the world can that be bullish? There are literally millions of people who are losing their jobs in such a short amount of time with zero understanding of when they could potentially open, right? The summer, that is so far away. And these stimulus packages, yeah, they are bail-ins, and they're sending money to individuals, which is a lot better than what they did in 2008, which is a good thing for the everyday American. But, they're just, in my opinion, how can that be the bottom? It's the economic turmoil, in my opinion, is sadly to say kind of just getting started. So the theory of the stock market hitting a bottom, in my opinion, is invalid, and I'm looking for shorts. So this is going to really overlay well, in my opinion, with the analysis that we're going to have for the S&P, because we are looking to aggressively short the stock market, the S&P in particular, the index. And we're going to basically go every day. We do a video every single weekday, and we provide analysis. We provide our ideas out into the open for everyone to see. So there is transparency in our message. It's not like we're saying long, short, long, short. We don't really know. We have a bias, we have a system, and we're going to talk about that system within this video pretty in-depth, looking over 2001 and 2008 as well. So we're going to go over both the 2 most recent stock market crashes, understanding the structure of the moves. Yet again, we've made this video in the past, but this is going to be another video going over the same information, because, obviously one video is not going to get all the views. It's good to just kind of stagger them so there's multiple ways to actually see this historic price action that I drew in. So before we get right into it, I just want to talk about more of the fundamental factors and more of like kind of the economic side of what the government is doing. And we can see right here, if you don't know what MMT is, we'll talk about it a little bit within this video. We're not going to get super in-depth and really dissect this economic theory, but we will go over what it is, because there was a few economists who were looking at this as a potential way to solve the debt crisis, really, and they don't think it's that bad. We'll get into it, but we can see here Jerome Powell says that concept of MMT is just wrong. And we'll get into another Investotopia post, but we can see MMT, as the concept is dubbed, argues that because Americans borrow in its own currency, it can always print more dollars to cover its obligations. As a result, the thinking goes, the US dollar, or the US, can always run sustained budget deficits and rack up an ever-increasing debt burden, helping grease the wheels for some MMTers in the expectation that the Fed would keep rates low to contain the cost of servicing American obligations. So basically, the idea is they can print much as they want. They can, instead of getting their money through bonds, taxes, they would then say, let's just not do that, and let's just print money, because the money, that the currency we're using to pay off our obligations, we create. We have ultimate power of value, is the idea that MMT is proposing. Now let's get a little bit more into it here. This is the Investopedia post. What is modern monetary theory? It states that monetary sovereign countries like US, UK, Japan, and Canada are not operationally constrained by revenues when it comes to federal government spending. In other words, governments do not need taxes or borrowing for spending, since they can print as much as they need and are the monopoly issuer of the currency. So, to me, this is going against everything what money stands for. What is value to you? If they can print as much as they need to pay for those services, whatever it is that value to you? That is the question. MMT challenges controversial beliefs about the way that governments interact with the economy, the nature of money, the use of taxes, and the importance of budget deficits. The belief, supporters say, are a hangover from the gold standard era and are no longer accurate, useful, or necessary. So kind of what they're saying is something that has been tested as a true source of money and a true source of value holding and a safe haven like gold and silver is no longer accurate, useful, or necessary. True money doesn't really need to be taken precedent. It's just a new economic belief that was really only started in the 1970s when it kind of first came into an idea here. And you're probably screaming at the top of your lungs here. What is how would inflation play a role in this, right? And we can see that right here. Traditional thinking says such spending would be fiscally irresponsible as the debt would balloon and inflation would skyrocket. Yeah, I definitely would agree with that as well. MMT theorists explain that national debt is simply money the government put into the economy and didn't tax back. That's all it is, right? For them at least. While supporters of the theory acknowledge that inflation is theoretically a possible outcome from such spending, they say it's highly unlikely and can be fought with policy decisions in the future if required. They often cite the example of Japan, which has much higher public debt than the US. And that's the way that they're going to go about trying to implement this. And it's already being done, right? Look at the tax cut that Trump did, and then look at how much money printing that they're doing, right? In my opinion, they are going into MMT territory. Taxes create an ongoing demand for currency and are a tool to take money out of an economy that is getting overheated, says MMT. This goes against the controversial idea that taxes are primarily meant to provide the government with money to spend to build infrastructure, fund social welfare programs, etc. So this is like a crazy theory, in my opinion, that is... I can't believe that it's going against a lot of the, in my opinion, foundational values of what money is. So taxes create an ongoing demand for currency. So the people within that economy, let's say you're living in the United States, you have to pay your taxes in US dollars. You have to, let's say you're using another currency. You have to buy US dollars in order to give it to the government, which then they'll just destroy it anyway because they're trying to take out money out of the economy if it does get overheated. So basically what they're saying is if there is ever inflation, they'll just tax the shit ton out of people, the people living in the economy, and then just burn all that money basically to try to reduce the amount of supply in the monetary base basically. And that's a dangerous road because let's say there is a significant increase in inflation or even hyperinflation. If they just continue with this, taxes create an ongoing demand for currency. So that's what they think taxes are used for in MMT. Taxes create an ongoing demand for currency and are a tool to take money out of an economy that is getting overheated. Inflation, right? The velocity of money is going up. The inflation is going up. You want it to cool down. So you're using taxes and taking and extracting currency out of the supply and then burning it, trying to shrink the circulation supply. And let's say there's a significant amount of inflation, they're going to significantly tax people, right? And if it's hyperinflation, well, who knows how much they're going to tax people? Because this is how they're viewing tax instead of a means to spend and build infrastructure, fund social welfare programs. In MMT's view, build infrastructure, print money, pay for that. Social welfare programs, print money, pay for that. Very different views of how money and government spending and deficits should be viewed. Unemployment is a result of government spending too little while collecting taxes, according to MMT. So basically, if there's ever an unemployment issue, print money is the way to do it. Spending too little, right? So they need to spend more and more and more. Now you think that the government would use some tested theory or some tested measure before implementing it into any economy, right? You'd think because the US dollar is the world reserve fiat currency, everything is somewhat linked to it in terms of commodities and inequities in the United States anyways. And there's a lot of things connected to the US dollar. And if you're going to implement an untested measure that would greatly impact that entire currency, I would have assumed that it would have been tested for a little longer, because the Oranges of MMT says that it was developed by an economist, Warren Muller. Musler first began thinking about some concepts form of theory in the 1970s when he worked as a Wall Street trader. Right? Crazy. And we can see in 1993 he published a seminal essay called Soft Currency Economics and shared it on a post-Keynesian listserv, I don't know what that is, which is where he found others like Australian economic Bill Mitchell who agreed with him. So yeah, like it wasn't very long ago that this MMT theory actually came into existence. And in my personal belief, this is just me thinking out loud, and it's not going to be yes or no, right or wrong. This theory is going to create inflation, and MMT's argument of inflation is we'll just increase taxes and take out the excess currency and then burn it, and then there's less currency in demand. But think of that, how that would impact the everyday citizen if you're going to raise taxes that much, right? That is an experiment that does not have an outcome that is positive. That's going to help anyone other than the Fed and the government, really, in my personal belief. It's going to absolutely demolish savers and demolish the individuals within an economy. And they're basically just saying fuck you to gold and silver, really. And we can see right here, the US dollar, the value of US currency over the years. Now, this is, if you, let's say, like you invested, you can't really invest in this. This is a depreciating asset. But let's say you bought something that held its value in 1913 for $100, right? And if the US dollar didn't lose value or anything, your value, you would be over $2,500, right? This is compound interest working in your favor because you're seeing the gains go up, sometimes substantially. 1913 to 1920, that's almost a 100% jump. That's a significant move to the upside, right? You see some of these massive jumps here. This is almost double here, right? And then the flip side is seeing it actually devalue. So from 1913, when the Fed was created, the purchasing price or the purchasing power of $1 was $1. But now it's worth less than a penny, right? Look how low that value is in purchasing power compared to what we saw back in 1913, right? That, in my opinion, is absolutely unbelievable. And this is why we need actual real money, not currency, not fiat currency. They can literally print as much as they want of this. Does not matter for you and me. You don't make the decisions. I don't make the decisions. All it is debasement of currency, and yeah, you just get wrecked if you're a saver and you're not hedging or anything. So yeah, just definitely keep an eye. It's not something that happens overnight, but it's over a long period of time. But if you're not hedging, you are losing out on some serious debasement of currency here. And I think it'll only get worse, right? Because now it's the last hurrah. They are really fighting a serious virus, obviously, but in 2008, they reacted with QE and dropping interest rates to almost zero, and that obviously rewarded them with the longest bull market really in history for the United States. So they got rewarded, in my opinion, for bad behavior. They equated money printing, QE, stimulus equals positive economic outcome, right? That in their eyes, and simply put, is how they're viewing how to solve any issue economically speaking. Is any economic issue, oh shit, let's just implement QE, stimulus, money printing, low interest rates, and just keep this debt cycle going. And that pushed us through 2008, 2009 when it looked really bad, and it'll push us through now, and it'll push us through every other time when we need it. This is the Keynesian economic MMT type psychology that is taking over almost every central bank, really. There's not one central bank that is being, sensible and not printing a shit ton of money. Every single central bank is printing a shit ton of money. So it's a global event, and it's interconnected, because obviously COVID's like around the world, and a lot of economies are having a tough challenge, but it's a theory. It's not a tested measure. So we're all living in this theory of will it work? How long will it be able to be sustained? And then this last picture here, this is how actually true money holds value over time. We see that in ancient Rome, this was in ancient Rome, in the Roman times, an ounce of gold, which is today roughly, let's say, $1,700 USD, somewhere just under there. It moved up. In Roman times, an ounce of gold was enough to buy a quality tailored toga, sandals, and accessories. Right? Crazy. Great Depression. During the Depression, an ounce of gold was enough to buy a quality tailored made suit, shoes, and accessories. What can you buy for $1,700 today? You can buy an ounce of gold, can buy a great tailor-made suit, shoes, and accessories, which you definitely can, and you can probably have some more money if you really wanted to go out to eat or something. But at the end of the day, $1,700 could definitely buy you all of that, but then also you could spend more than $1,700 easily on those items. A tailor-made suit, shoes, and accessories, you could definitely spend much more than $1,700 on that. So yeah, just looking at how long history is for gold and understanding at each of the time frames here. Think of how long Rome was, and money, aka gold, was still used as a medium of exchange during that time. And the great speculation in the digital age is going to be cryptocurrencies, right? The digital gold 2.0, as what many people call Bitcoin, and this is the huge speculation, right? And only time will tell. No one has a crystal ball. No one can tell you that it's a guarantee that Bitcoin will be a digital store of value. As of right now, it's deflationary in correlation with the US stock market. There's actually a positive correlation around, let's say, in recent times in Q1 of 2020. I believe it was in the 0.3s, 0.25s. Or no, it was 0.5, sorry. It was 0.5. And Q1, I just did a video of it today. So it's 0.50 in Pearson's correlation coefficient. Google that if you don't know. It's like the it gives you a statistical number from 0 to 1 or -1 of how correlated an asset is with another asset. Gold's actually negatively correlated with Bitcoin, which is obviously not what we're looking for during this time, but still very, very early in the stock market crash, basically, in my personal opinion. So that is going to be the wind-up for the news stories. We'll now jump right into the charts. Hopefully you enjoyed it. Definitely a little bit more tabs, getting more into more of the larger time frame aspect of, in my opinion, where we're going. Obviously, no one understands for sure, but I definitely think that the economists at this point can agree that we're nearing or in MMT territory, because Trump cut taxes. We're printing money to pay for basically everything, government spending, stimulus packages, universal basic income, healthcare in the United States, really everything, right? So we, in my opinion, are in MMT territory. So we are now in a territory where we're in completely untested waters. We have no idea if this is actually going to work for a long term. The only thing that economists are saying is, are pointing at Japan and saying, hey, they've been doing this for a while and they're all right. They've been in a slow deflationary spiral and they haven't seen inflation, but you have to consider the demographic cycle. Always, you have to consider all aspects, 360-degree analysis, right? Japan has one of the worst demographic pyramids, where the largest population is going to be the baby boomers, the old generation, and their spending habits are going to be very different than a country that is much younger, right? As the older you get, you need to think about retirement savings. You don't know how long you're going to live. You're not going to be working, and it's rather scary if You don't know how long you're going to live and if you have medical conditions and all that stuff, so you're going to save. And that is going to reduce the circulation of whatever currency you're using, which is just basically the decrease of the velocity of the currency, which is deflationary. It's not inflationary, it's deflationary. So you're having the largest group of individuals within an economy to start saving substantially, right? And that is going to decrease the circulating supply, the circulating velocity of that currency, which is deflationary. So it's combating what would be price increase due to inflation and the circulating supply increase. So there's two things that are going to impact inflation, right? Inflation is the actual definition is the increase in the circulating supply of the currency, but you don't see the inflation, right? It's one thing to have a circulating supply that's increased, but if the everyday consumer, if their goods and services are not going up in price, they're not gonna worry. It's only when you see those goods and services go up in price that people start to say, hey, this is not all right. Why is the prices going up? And then at some point, there's going to be a chain reaction. People are going to say, well, fuck it, it's just going up in price. Let me buy that thing I was going to buy later, but I know my value is going to get decreased by the day, by the week, by the month, that I'm willing to buy it now because I know I'm going to have less value in the future because I see the inflation hit me, right? And that is where you get into inflation to hyperinflation territory because you have that sense of perception where you can actually see the inflation. It's different when the inflation hits real estate and stocks because people are happy. Stock prices are roaring, right? And QE did that. They inflated stock prices in real estate and art and the things that are assets that people speculate on. It went up in that, right? So yeah, it's just a matter of time, I guess. Yeah, we'll see. Hopefully that gives you some insights. I don't want to go too far into it because I could talk about this for a very long time. But now we're going to go straight into the charts here after talking about that for quite a long time. Hopefully you were able to get some value, get some information from that. All right. Let's now continue on to the commodities. We're going to go to gold, silver, and then quickly looking at the gold and silver ratio, and then ending off with U.S. oil. So let's go to gold here. Yesterday, we did talk about a potential move to the upside, which did occur. I was not on that bull train, unfortunately. So here is that move that occurred. Watch yesterday's global macro update if you actually want validation. But let's actually look at the 4-hour and then discuss what we were looking at and then why we were looking a little bit more bullish. And before we get into it, why did I not want to enter long here? For one, just in general, because of what's happening right now, I am being more patient than normal because of all the shit going on. Obviously, I'd rather take a fewer number of trades and try to take only the highest probability situations, because in these times, if you're trading smaller time frames, you're going to get absolutely wrecked because there's a lot of noise, a lot of uncertainty, a lot of emotion driving the price both up and down, right? So in my opinion, during these times, you have to take a step back, lower the time frame, be patient, and only take the highest quality setups. And not all the things aligned in this trade. I'm hoping for the S&P and Bitcoin, which are more correlated, and gold's negatively correlated to the S&P and Bitcoin. I was expecting the S&P and Bitcoin to move up a little bit higher. And because gold is negatively correlated with those two asset classes, I did not want to enter a long on gold when I'm already long Bitcoin because they're negatively correlated as of now, right? And yeah, I could have made money on both of them. Gold did end up going up, so theoretically, yeah, that would have been a good trade, but I did not enter it. I'm totally all right with that. The setup I'm really looking for, and what I'm setting myself up for, is going to be the SPY short, the SPX, or the S&P 500 short, that we'll get into within this video. We'll go over 2001, 2008, what happened, and the system that we back-tested in those two bear markets or stock market crashes, and what we extrapolated from that information and how we can implement that the stock market crash and what we've learned and how we can position ourselves to make money in this next leg down, in my personal opinion. But yeah, strong push up. Now it's hitting $1,700 resistance right around here. Now going to quickly the daily chart. Let's just take everything off. So in my opinion, that was a massive rally here, and what it looks like now is actually a really nice reverse head and shoulders. So we can see right here, I was really hesitant on entering long because we held this lower high. This is a high, this is a high, this is now a lower high. So market structure is telling me I'm a little hesitant on entering long, right? We did have a trend line there. It broke resistance, tested for support, but at the end of the day, I was a little bit hesitant on entering when the price has not broken or even tested this high there. It actually was below the recent high, which is, for me, a market structure lower high. And this was a low, this was a lower low. So, you know, I didn't want to come to too quick of a conclusion, basically. So I was being very patient. But right now, what we see is going to be a reverse head and shoulders, right? We see a high, we see a high, we see a high, draw a horizontal level of resistance right here. This is going to create the breakout zone of the reverse head and shoulders. We have the left shoulder, we have the right shoulder, and we have the head. Hopefully you're able to see that. I will draw it again just so you have a better understanding of it. You have the breakout zone right here. You have the one shoulder, right? Kind of like that. And then you have the breakout zone right like that. And what we're looking for is a break above 1700 and a retest of that zone to confirm that reverse head and shoulders. Hopefully that looks like a head and shoulders to me. To me, it looks like a great reversal pattern. What we're looking for is a break in our key resistance around 1700 to make that structure higher high. So then we have a confirmation that all the shorts basically who have entered anywhere between March onwards is now in the red. So then if it does increase higher, we have a probability of a short squeeze if there are shorts in the market. Also for the bulls, we've broken the recent high, which is super bullish, and we made a structural higher high on a significant daily time frame, which is very important. And all we're looking for is a nice pullback at the completion of the exhaustion. We could be looking, let's just get rid of this. You know, it might not be an instant pullback and then an explosion up. It might be a little bit of hesitation. We could see a little descending zone where you get a series of lower highs. You connect it with a descending trend line, and then you get a squeeze. And then once that squeeze pushes up, you're looking to long. We don't exactly know what's going to happen, but we're looking for that structure higher high and higher low, and we're looking to capitalize on that move. So in terms of next opportunities, in my personal view, I'm not really going to be looking for any longs until we break this key structural resistance, just for the highest confirmation trade, in my personal view. And it's on a larger time frame, so it's fine. But like I said before, with so much going on, I am trying to really be patient and stick to the highest probability trades. And that was a pretty high probability trade. It actually broke out at like 4 or 5 in the morning. We can see it started trending up because I did see a consolidation right here, and we talked about that within the previous global macro update. Let's just quickly talk about this here, and then let's discuss silver. So we saw this descending zone, which was like this, but then we also saw a consolidation, which we can see right here, where we saw a resistance, like so. So the first confirmation would be the break of this descending zone, but if you wanted to play it safe, the entry would be the completion after the break of this resistance, and we can see nice wicks below the zone and cracking back up. So an entry here would probably have been a good idea. Looking at what time it was like 3 in the morning, 4 in the morning. I was unfortunately not up at that time, but that, in my opinion, would have been the highest probability situation with a take profit at around 1700, which is your next level of resistance. So yeah, it was a good move. It was a solid structure, but at this point in time, I've talked about what my criteria is for a trade, and if I don't see it, I'm just not going to enter. Silver is going to be basically my short opportunity if the commodities do go down. In my opinion, I think it's a good idea to have, unless there is a huge shift in the gold and silver ratio where you start to see a huge shift in silver being less undervalued, because right now silver is extremely undervalued. We are at 100 right now, and we haven't seen this in decades and decades and decades. And just looking at this chart, we can see that silver is very undervalued, and silver is a more speculative precious metal. So when we do start to see that shift from the US dollar into more precious metals due to inflationary worries, I do think that silver will be a more speculative, more volatile, both upside and downside asset compared to gold. And it's great to have gold, it's great, but at the end of the day, I think silver will be able to have those price appreciations at a more faster rate, in my opinion, than gold. But doesn't mean that gold shouldn't be regarded. But until we start to see this bend in like CPI go up, CPI's Consumer Price Index, it's a good way to understand inflation. If you're seeing inflation start to increase and worry and worry of obviously that happening, that would be an indication that people are going to be going into gold and silver, and obviously that would be super bullish and we'd be looking long. But as of right now, I don't really want to be looking long at both just yet. We do see a very nice ascending zone occur on the silver chart connecting the higher lows. If it breaks, that could be a potential move to the downside. We haven't seen gold break $1,700 yet, so we don't want to completely assume that the market structure is shifted and we're going to move to the upside. This could be a consolidation sideways. We haven't broken the major $1,700 high, so it's, in my opinion, too soon to say that gold is gonna really move to the upside here. If we do break above and then start testing the $1,700 zone as a new level of support, my bias will definitely change. But as of now, I can't have that bias of extremely bullish on precious metals just yet. On the macro scale, different, but we're swing traders, so it's a different outlook. All right, talked about the gold and silver chart, not a whole lot more to talk about. US oil, all right, let's talk about this. I'm not a huge crude oil trader, but I'm fascinated by charts, so obviously like to look at it. All right, let's just talk about the 4-hour chart here. So this was, I guess, that double top. I thought it was going to be a little bit longer duration, around $28, but we did get that double top there. So if we do break $23, I do think that we're going to get another leg down. It seems like this is a small little pullback. If we do get the fib from high to low, it's probably going to be at 61. Let's just look here. Fib to the low. Almost hit 51. Right to the low there. So it's in between the 50 and 61.8. Almost hit 61.8, but it didn't. But yeah, I do think that after this double top here, if it does break the $23 zone, I think that it's probably going to test the $20 zone yet again. And then it's just a matter of if we're going to consolidate sideways or if we're ever going to actually break this $20 zone, because this is a major psychological and technical zone, the $20 area. We did hold this descending zone connecting the lower highs, got a squeeze of the price, broke to the upside, and now we've confirmed this $28 zone as our new structural resistance. So the way I'm viewing the market right now is now going sideways, where we have a strong level of demand at $20 and a strong level of supply at $28. And we're going to continue going sideways until we break the market structure higher high, breaking $28, where then we're going to look for confirmation of the bulls entering at the low. And if we do break the $20 range, we're probably going to be looking for a confirmation from the previous support to the new level of resistance at $20, because as we can see, a lot of people are lining up at this zone. So that's going to be my analysis for US oil. All right, now for, in my opinion, the funnest chart of all, S&P. All right, let's go and, okay, let's first discuss the large time frame. So we're going to go over 2001 and 2008. So it's going to take a little bit of a while, not too long, but yeah, I think that this is super valuable, and in my opinion, it is going to be a great opportunity here for the short. So let's go zoom all the way out and first look at 2001. Actually, okay, let's first talk about what our system is in the first place. So this is how we're going to structure our trades. Also, this is the S&P 500. We're talking about the S&P 500, the SPY, SPX, whatever you want to call it, the index of the 500 largest companies in the United States, whatever index that is to you. in my opinion, we're going to have 3 major pushes to the downside, right? We got 1, 2, 3. That's my opinion. And we've seen that in 2001 and 2008. We get 3 pushes, major pushes to the downside. And what we have is 2 corrections, right? And we'll call these correction number 1, C1 and C2. And this is P1, push 1, P2, and P3, right? Let's just say that. What we're looking for is to capture profits on P2 and P3. And we're going to look for the setup on the correction 1 and the correction 2, right? And that is how we're going to play the market. We're going to assume that this is going to play out because we can see this exact structure both in 2001 and 2008. Right, and we'll talk about the structure after, but this overall is what you're looking for. You're looking for that first P1. You don't need to enter the first push. We just had that first push. When people are saying that's the bottom, that's the end of P1, right? End of P1 is going to be the bottom that we just had. Now we're entering C1, correction 1. That's currently where we're in right now, in my opinion. We're setting up to enter the next phase, P2. This is where the first main amount of money is going to be made for the stock market sell-off. This, in my opinion, is too hard to predict. I'm okay with just making money on P2 and P3. So right now, we're in C1, right? Correction 1. We're going to make money in P2, hopefully. This is the setup we're going to talk about in the structure that we're going to go into within the recent price action. And then we'll go over correction 2 and push 3 within 2001 and 2008. So overall, that's going to be the structure that we're going to be looking at the market in. All right, so this is 2001, right? Or the dot-com boom. It's not just 2001, but I'm sure you know what I'm talking about. So, and then also, with those pushes right here, sorry, I didn't talk about fibs. What we're looking for, let's get our red, is we are looking for the fib retracement of 50% to around 61.8, right? These are the 2 key retracement levels that we're looking for. So from the high of P1 push right here to the low where it starts C1, the retracement is around 50 to 61.8. Right? And that is the resistance zone that we're looking for. So just keep that in mind. And then we draw a resistance zone like so, where we have the retracement 50% to 61.8, meaning it is going 50% up to the initial start of the high there. I'm sure you know how fibs work. If you don't, there's a bunch of information on Google. And then C2, correction 2, same thing. You're getting the high of correction 1 and the low of push 2, and you're looking for that 50 to 61.8, and this is going to be your supply zone, and you're looking for weakness around that zone. And these are going to be the 2 prime areas you're looking to short. Now, understanding that, let's now take it into reality of what actually happened in 2008. Let's look at the structure we just talked about, this zone right here, right? P1, P2, P3, C1, C2. So now let's actually go over the 3 pushes and the 2 corrections here. Let's go white. Do you see P1? I do. This is the high of 2000, and I guess 2000. So it hit this twice, and this is the very high of the stock market in 2000, dot-com boom. So this is the high right here, and then we see our first push to the downside. This is that first, wow, that was a big move because we saw a major support right here, absolutely broken, and then push to the downside. That's a huge move, right? So that's going to be your initial P1. So this is P1. We don't need to trade this. We don't need to make money on this. We don't need to speculate on the first push down. It's okay, right? Now we're looking for C1, right? This is going to be C1. We've seen the bottom. Now we're making higher highs and higher lows. Okay, we know that it's a correction. We don't need to exactly catch the very bottom. It's okay, right? we're now looking for, what did we talk about? Retracement up to 50%, which is right here, and 61.8, which is right here. So what did the price do? The price just touched the 50% retracement level. And what do we see here? A nice head and shoulders pattern. Very, very clear. And then we saw one test of the resistance, two tests of the resistance, and then it fell. And at that point, you should be looking to short because that's a really high quality, high dependability pattern in my view. That is going to be the entrance of the C1 failure, right? Correction 1 failure. This is the correction. This is the pullback. It hit 50%. We had a weakness. We had a weakness price action structure where it was a reversal from bullish to bearish, and that was a head and shoulders. We got that. That was a great opportunity. So if you entered at that zone, this would be around where you could go, right? And how we're going to be doing it is we're going to look at the extensions. 272, that's what we're going to be looking at. But at the end of the day, having the entry is the key. Then you're just riding the wave of the momentum down, and you could set a trailing stop loss because, as we can see, there's no real major pullbacks until we get a strong bounce up. So trailing stop losses would be good. You could also look at take profits for extensions or previous historic levels of support and resistance, but I'm primarily looking at the 272 extension from that P1 push where you have the two anchor points there, and then we see that it landed very close to that take profit zone. That's going to be your first trade, right? This is the one coming up. Now, once that is complete, this is P2, right? This is P2, push 2, and this was correction 1. This is C1 right here. Now, what are we looking for again? Right? We're looking for C2, correction 2. But what are we using? We're using the previous high of the correction and the previous low of P2. Put a retracement there, a fib retracement, and then you get 618, 50%. What do we see? We see the price hit the 618. Remember, it's a zone. 50% is 618. It's a direct price. It's going to be a zone that we're looking as sell pressure, as supply. We get initially an ascending zone right here, and let's just take away that so it's a little bit less difficult to see. And those, we see an ascending zone, as you can see, 1, 2, 3. Let's connect those guys, and then we see a break. We see a break in market structure, break in a ascending zone, which is price action. So that, in my opinion, would be a decent place to short. But what you're making sure to do is setting your stop loss above the recent highs, because as we can see, you actually are going to be in the red a little bit before you get a major move to the downside if you're going to be holding all that. So just something to consider. You got to be patient. You got to be able to have a stop loss, completely accept the amount of risk you're taking on. So if you're entering at these zones, let's say you get something like this, and if you do get the price to come back a little bit and you start going red and you're actually losing a little bit of money on the trade, I'm going to be very patient because I've seen something like this occur before, and I'm willing to take that little bit of red, a little bit of time where I'm in consolidation, losing money before I start the momentum back down to the downside. So that's going to be the first opportunity, and then we see another trend line connecting right here with 1, 2 rejections of a resistance zone, and then we see also as a double top with this breaking, retesting, and then massively moving to the downside. So that's going to be your second structure. That's going to be your C2 structure. You could have 1 or you could have 2, whatever the case may be. You could have entered both. This is the more aggressive one, and then if you didn't enter there, that would be your second opportunity, in my opinion, to be entering short. And then you get a strong move to the downside. We see that the 272 was hit with a little bit of an exaggeration before bouncing back up. So that take profit does yield some pretty good opportunities here as a massive move to the upside here. Just personal opinion, right? So that's going to be 2001. As we can see, the structure that we have described works very well, and it's not like we're doing it like we're conducting this analysis within the current market structure, and we're going to post it on YouTube as well. So right now, just looking at 2001, our structure, our idea, our system for capturing profits in a bear market yields to be a very profitable system as of 2001, right? And we'll look at 2008 right now. So that's going to be how I set up my system. let's do two more examples of 2008. Exactly the same structure and exactly the same way we are going about trading this market. All right, so let's get this yet again. Gonna get a little bit of coffee and then we'll continue on here. All right, so we got yet again P1, right? Key level of support, broke down below the support, major market move, significant push to the downside. That's your P1. You don't need to trade this. That's okay. That's going to give you the initiation of this major market crash, right? So that's going to be number one. Now you're looking for C1, right? C1. Correction 1. Remember, you got P1, C1, P2, C2, P3, P1, C1, correction 1, push 2, correction 2, push 3. Right? So P1's right here. We're looking for C1. We can see very clear ascending zone. We got 1 touch, 2 touch, 3 touch, and then you see it really perfectly touch the 50% level there, and then you see it fail this ascending zone. You see a horizontal zone test as, in my opinion, this could look like a head and shoulders to some degree, or you could just use this break and then look for a resistance. You tested 1, 2, 3, and then the last one you got a major bearish engulfing candle. The candle closed below the support. That, in my opinion, was a perfect opportunity for a short. That's like the most perfect situation that you could ever have for a short, in my opinion. I would be entering every single time if I saw that situation. So that's going to be a really good opportunity. So that's going to be this first entrance right here. Let's say you caught it. Let's say you caught it here, or even up here if you're a little bit more aggressive. But like somewhere around there, once you see failure and support's broken, ascending zone's broken, you see weakness within the bulls. And then you see the extension 272 just gets hit right here. So good thing to kind of explain. You can't be 100% greedy and expect that perfect zone. If you see it close, if you're only a couple bucks or whatever close to it, might as well take profit. But yeah, I think that 272 will yield like a pretty good level of a take profit in my personal view. And then this was that P2, as we can see, P2. And now what are we looking for? We're looking for C2, correction 2, right? Now, what do we see? Correction number 2. Let's just close this so it looks nice and clean. This is correction 2. Now, correction 2 didn't actually touch the 50%. It was very close, but we can see there's a gap right here, right? And this just shows me how strong the sellers are. It didn't even hit the 50% retracement. So then it could tell me that obviously it's pretty hard to know beforehand, but because it didn't hit the 50% retracement level, it like every single one did beforehand, but this one didn't, which shows me that we could have significant sell pressure. And what did we get after that? One of the craziest stock market crashes. Look, not the worst, but one of the most recent here. And we can see it was a massive push to the downside. And this was P3, right? Because this correction is P2, or sorry, C2, not P2, correction 2. So we can see out of the 4 pushes to the downside that we went over, almost all of them hit the 50% or 61% retracement level. And we also saw a very clear price action pattern give us weakness and give us an opportunity to short in the market. Like, for example, this one right here, we saw an ascending zone like we saw here. Although it didn't hit this zone, we broke market structure, breaking the support, and we tested once and we tested twice. We can actually call that 3 times if you really wanted, but 2 major ones. You could call this one a test 2, but you saw 2 major rejections, and the third test yet again was a bearish engulfing candle. So you got a bullish candle like this, and then you saw a bearish engulfing candle close below the previous open of the candle, which is a super bearish candle pattern on a already market structure price action pattern that is bearish, looking to move to the downside anyways. So that's going to be my analysis from 2001 and 2008. Now, in that said, you know why I am putting my fibs, putting my lines where I am. And I walked through exactly how I'm viewing the market. Now let's turn to present day with that fresh in your mind. That push 1, correction 1, push 2, correction 2, and push 3. 2016, 2018, 2019, and 2020. So, on the daily chart, what can we see, right? This is P1. I did not need to enter P1. I'm very all right with that. We see the price come back, and we are now testing the 50% fib level. So we're now in the range where we're looking for sell pressure. We're looking for supply to come into the market. And that's going to be the large time frame outlook that we're going to have. And in order to understand why we think this is a supply zone, we needed to go back all the way to 2001 and 2008 to understand why we're using this strategy in the first place to look for short opportunities in this current market. And also we went over the previous news, more fundamental analysis, I guess, fundamental news, because of the fact that a lot of people think that this is the bottom. Oh my God, $2,200 is the bottom. Why didn't I enter? Everyone has their own opinion. I respect that immensely, and I think that's why the markets are so awesome, is everyone has their own opinion, and you basically place a bet on your opinion from the information that you're able to gather through your own resources that you're able to find. I find that absolutely fascinating. But anyways, to get into the more recent, what we're actually seeing right now. All right, let's talk about market structure here, because we've already talked about this 50% to 61.8%, which is going to be these zones right here as a key level for us. So we've just tested that 50% level, which is at the top here. This one is 61.8. So this guy right here, I'm not going to draw it, but you understand 61.8 and then 50%. So we're testing this zone right now, but we're getting a major ascending channel, which is right here, which is a bear flag like this. Or we're getting that because we have an anchor point right here. We have 1, 2, so we're probably going to get some level of interaction when we do come back down to this level. But the more actionable, shorter term time frame that I'm looking at for a potential break is this ascending zone right here, which is creating a wedge against this resistance zone right around here. And we see it as a level of support, resistance, resistance, resistance. We do see a gap, so I'm waiting to see if the price is actually able to get to that 61.8%. I don't want to enter too short, but at the end of the day, my stop loss is going to be above this zone anyways, probably going to be above this candle wick right at that zone, like 29.50, let's say 29.80, somewhere around there. And I'm looking for shorts either if it breaks this ascending level of support, and also when it breaks this level of ascending support. If it breaks this top, my entire analysis is wrong, basically, and I'll have to go to the complete drawing board and look at different ways of try to constructing systems to try to profit from this current bear market. But as of now, the theory is still valid, and I'm going to trade it as such. So in the short term, I do see this zone right here and this zone right around here in confluence with this resistance right here. So I see a lot of sell pressure at this zone here. So if the price is able to continue deeper into the wedge, that's great. I don't mind, because I'll just get a better price of an entry of a short. And that's going to be how I'm going to view the market, is the price is continuing. Once it breaks this, that's going to be my first opportunity to short. This is going to be a bit of a feeler trade, because the highest confirmation is going to be this ascending zone right here. But that's going to be my first entrance, in my opinion, for a short. And I'm going to put a stop loss above right here, like I said before. And then once we start to see the break of this ascending trend line, hopefully this zone gets tested a couple more times. I'd really like to see that tested a couple more times. So if we go up a little bit here, so let's get our green or our lime. So let's say the price comes up a little bit higher and then starts to crack. So a little bit higher and then cracks down and then pulls back a little bit. In my opinion, holy shit, that's a great opportunity for a first short. That's going to be my first opportunity. Stop loss at above the high there. Like I said, right above the high there. I want to see the high get created here first. So that's going to be a first opportunity to short. And then it can kind of consolidate, go up a little bit, do something. I don't exactly know. Stop loss is still going to be here. We don't know exactly what's going to happen, but once it breaks this second ascending zone, hopefully it tests another time, 2 times hopefully, but when that breaks, that's going to be my second entry level, with the first being, like I said, when our more aggressive ascending zone breaks. But we have another ascending zone, and when that breaks, I think that is when we will start to see the price move to the downside. And then, like I said before, we have a system for looking at TPs and all that stuff. So the setup is here. In my opinion, the setup is coming. I'm waiting. I'm patient. I've been a little less active trading cryptos to some degree, just because of like so much happening. I'm just reading a shit ton in terms of global macro and just trying to understand it all. And yeah, I'm super fascinated and interested in it, obviously. So to me, it's like waking up every day and just looking more into something that I have a lot of passion about. But this is going to be the potential next biggest trade here for us, and we're doing it. You know, we do a global macro update every single weekday, so you will get a play-by-play on a daily basis throughout the week of how this system is actually working for this stock market crash. I could be completely wrong, and you know, this could be the bottom. I don't know. There's no way of knowing. I have a system that I found seems to have worked in 2001 and 2008, and I feel confident using it because it allows me to use stuff that I have edge using, like ascending zones, squeezes, trend lines, and just technical analysis that I have edge using, also combined with the fundamentals of COVID, I think positions us for a very high probability, high risk reward situation on our hands. But like I said before, I'm not a financial advisor. I'm not telling you to do anything. You have to come to your own conclusions as to why you want to do it. If you want to long right now, I think that you should do your due diligence, and if you think that it's a good time to long, you should long. I'm not saying that one idea is correct and one idea is not correct. Every single person has their own reasons, own beliefs, own biases, and I shouldn't be the one to change your bias. You should be the one to change your own bias after, you know, coming to your own conclusions. So basically, that's going to be the the global macro update. I am expecting the US dollar to move up after the sell-off, because obviously when equities sell off, they are a pair as well. What are they paired with? The US dollar. When equities sell off, there's a huge amount of buying pressure in the US dollar, especially if other assets are selling off as well, like gold, silver, oil. They need to sell in the US dollar, and that means you're buying the US dollar, which means that the US dollar index will go up in price, right? So that is probably going to happen. It's going to be kind of at the same time or similar times. And you could get exposed into both markets. I don't think being overexposed is a necessarily good thing. Like, for example, if you think that Bitcoin is going to go down, you would be shorting, Bitcoin, Ethereum, Ripple, BNB all at once, and that's a lot of exposure. Or if you're like shorting real estate and you're shorting stock markets, they're very correlated. And being overexposed is something that should be worried if you're not managing risk well, because if you have multiple positions, it can get a little bit tricky. But yeah, at the end of the day, that's going to be my analysis. I'm going to keep with this system, this plan. And, we've been very consistent time and time again talking about what our plan is for this stock market crash. And a lot of people have been like not so open about it. Some people are, but in my opinion, this is not going to happen very often. Like the last time this has happened was 2008. So really it does not happen very often. And we're going to try to, we'll absolutely kill it, obviously. I don't know if it's going to happen, but that's the goal really. And then we're going to have that on YouTube for the rest of our business life, which would be pretty dope. So, yeah, we'll see how it goes. I don't really have much more to add on to what we've already discussed today. So that's going to be the end of the global macro update. We will always go over the questions from TikTok and YouTube before we actually end the video, but this will be the end of the recording that we'll post on YouTube and LBRY. Also, if you don't know LBRY, it is a new, not the application, it is a alternate to YouTube, basically, and we can see that we're starting to post on there as well because YouTube is having issues with banning cryptocurrency-related pages. So we have our Performante library channel, and we can see that right here. Subscribe if you want. We've got 3 followers. Not a lot of people know about library. I didn't really know about it too much either, but as YouTube becomes a little bit more as YouTube becomes less desirable to post on for cryptocurrency pages, we have to resort to different resources to allow us to share our content. So thank you very much for watching. We'll go over the questions right now, but that would be the end of this video. So until next time, traders, have a good one. All right, so that is going to be complete. Let's now go to the questions here. First, I didn't see a lot on YouTube. Afternoon, evening, how's it going, Truck Nubs? Welcome again. Pama, heyo, Pama, Bitcoin is my safe word. That's a quote from Mr. Elon. Truck Nubs, lol. Todd, that's why you don't pay taxes. Are you talking about infrastructure? I was talking about infrastructure and healthcare and all that stuff. Yeah, like express yourself a little bit more if you'd like. I don't exactly know what this was pertaining to. I don't exactly remember what I said every word, but yeah, just type in more questions or kind of statements that would give me a little bit more insight as to what you mean. D. Limousine, hello, I am Brazil. You are welcome to Performante Live. We are happy to have you. Truck Knobs always with the coffee. You know it. I fucking love coffee. All right, let's now go to the TikTok comments here. I'm gonna grab a little bit of coffee and then we'll continue on. Oh, it's so good. Just truly delicious. All right. Got a lot of people on TikTok here. All right, what do you think about oil? I'm in OCS. I just talked about oil. I do think that we're in a sideways consolidation between the supply zone of $28 and the demand zone of $20. To say that we're going to drop below $20, I don't exactly know. I would, in my personal view, if I was trading oil, I would basically just look to sell at supply zone, potentially buy demand zone, but I would be definitely more hesitant on longing. The market, obviously, momentum is still very bearish, so having a short at a resistance would be a much higher probability to depend on for a trade, but I'm mainly looking at the SPY because this, in my opinion, is going to be some juicy profits if it does follow the structure that I really want it to. But like I said, I have no idea. No one has a crystal ball, right? All we are speculators and using probabilities to our advantage while being able to manage risk really well. All right, what do you think about, I already did that. Are you a full-time trader? Yes, Bobby, I sure am. All right, I have a question about the SPY. Short when you have a chance. Yeah, I just talked about it. Furious Fang. Hopefully you got some insights from it. If you have any other questions, feel free to ask them now, even if they're not involving this SPY, and I'll be happy to answer them. What chart is this? This is the SPY. This is the S&P 500. You could call it the SPX as well. I traded the SPX 500 USD. But yeah, it's going to be the 500 largest companies in the United States. What's the SPY price at the top level of C2? The top level of C2 is not present yet because we're currently in C1, correction 1. This is still in correction 1, right? So remember how we have 3 different pushes and 2 different corrections? This is still the first correction. So the top of C1, the 50% fib is 2,800, give or take, right? Around 2,800. I look at price action. I'm not going to enter at exactly 2,800. I'm going to enter when the price action is screaming at me to sell, to short. And the 61.8 is at 29.44-ish. That's going to be the 50% and the 61, which is going to create your zone of supply that I'm using. Not saying you should use it, not saying it's financial advice at all. I'm just saying that's what I'm going to be using. What's the calculation on how low P2 will push the SPY? Push 2, all right. So for my take profit for my 272, it's roughly 1925, which does align decently well with previous structure of 2016. Might be a little bit of an over-exaggeration, but we can see that this was a strong level of demand back in 2015 and 2016, right around here. And this is in the previous price action structures. We've seen that this 272 fib extension was a pretty good zone to be taking profit. And we can see all the way back in 2015, 2016 that we, for a couple of years there, were dropping to that zone and pulling back up, dropping to that zone and pulling back up, showing that there's a lot of buy pressure around that $1850 to $1,950 zone. So it's not going to be an exact price, but let's say if you want to be a little bit more conservative, I'd go $1,900 to be the next the completion of the P2 phase, although we don't need to exactly know. 272 is a good area to be looking for profits in my opinion, but that's a phenomenal trade. So let's say we're a little bit conservative entering right, let's just see what that number is. Let's just put another one. I think I didn't do it very well. So let's just put it right around here. Let's say the stop loss is around 7%. And then your risk reward parameters are like 4.4, 4.3. And that's if you are entering all the way down here. Let's say if you're entering all the way up here and your risk is a little bit lower at like 2960. Let's say 65, doesn't really matter. And then your TP level 4.95. That's a pretty damn good risk reward in my personal opinion. And it's a pretty high probability situation. So, You could obviously just, if you entered and you actually started seeing the momentum go down, you could just hold and wait for C2 to come in with your already held positions to the downside, and then instead of selling, you could then just add to your position on the C2 pullback. But that would be, you'd be very, very aggressively selling the market if you were doing that and taking profits off the table. So then you have more profits to work with and more capital to work with for the second push. In my opinion, is a little bit, I'm not going to say much more. I shouldn't say what you should or shouldn't do at all. I'm just saying what I'm going to do. But yeah, that's basically where the numbers are. All right, let's continue on here. What is the benefit difference of shorting SPY and buying a stock like SQQ, the inverse, NASDAQ? Let me just see here. What is the benefit difference of shorting SPY? In my personal opinion, I'm not shorting the equity. I'm actually using contracts for differences, or CFDs, which are a lot more flexible. Like I can buy half a unit of the S&P, which is like, you know, instead of buying one share, you can buy half a share or 1.5 shares or whatever it is, right? So it's a lot more flexible. You can leverage. There's no gaps in the market on weekdays, and I absolutely hate gaps. In my opinion, gaps are something that you cannot manage risk. You try to argue it. You can't manage risk trading equities because there are many hours during the day when you are illiquid. You can't sell your position even if it's going down. Let's say there's some overnight news and you are holding some stock that has some really shitty news. You can, if you set a stop loss, let's say at $40 and it gaps down to 15, you're selling it at 15. That sucks. You could not manage risk. So that's why I don't like trading equities as much. Cryptocurrencies is a 24-hour market, 365 days of the year. You're always liquid, which is absolutely phenomenal. Futures and CFDs are also during weekdays, 24 hours. Oh, excuse me. So that's good. And then on the weekends, you're not able to sell. But, you know, basically throughout the week, you're able to sell kind of anytime, which in my opinion is a way to greatly reduce the uncertainty of a trade, which is, in my opinion, extremely, extremely important. So yeah, that's my theory behind it. All right, I think you answered that and I missed it. Yes, sorry, I meant C1. Is an inverse yes good if you don't have trading level to short? Yeah, SQQQ is an option. It's an instrument that you can get exposure to the downside, but I personally like actively trading on instruments that give me liquidity post stock market hours, and that's just personal preference. Some people like stocks because it allows them to not have to look at a chart when it's not stock market hours, because for example, in the crypto market, it's open on long weekends, it's open at 3 in the morning, 1 in the morning, it's open 24 hours a day, 365 days a year. So if you have a position open, you're probably going to be thinking about it 24 hours a day, unless you're sleeping. And that's just something that I've totally accepted. Not much more to it. Yeah. There's pros and cons to anything in life. And I've chosen to think about trading basically every waking hour, but then I can manage risk in a way that normal equity traders that are swing trading in a shorter time frame, that kind of like I do, are not able to manage risk. So there's pros and cons to every situation in life, and I chose to trade in 24-hour or more hours trading market. So yeah, that's going to be the completion of the video. I don't really see any other questions coming into the market. Hopefully you got some entertainment value. I don't exactly know what you're going to get out of this. Depends for each person. But in my view, I'm really looking at this as a potential opportunity, and I'm going to take action when I need to. And other than that, I'm going to stay very, very patient, because at the end of the day, these moves that are occurring, you don't need to trade, 30 times, 40 times, 50 times. You just need to find those couple big movers in a month, and that's going to be your big paydays, right? Like, you could trade little moves, and that's great, and you could make great money, but at the end of the day, these major moves are really going to be what you're able to capture a lot of money on, basically. So that's going to be the video. We've already closed our recording, so we don't really have to do anything of that sorts. And I got a few new questions here. I'm so new at this. Thanks, Bobby, on the talk. Thank you very much for helping out. If you're brand new, we do have a free Discord where we talk about stocks, crypto, commodities, and it's absolutely free to join. We have a good community member. It's professional, it's friendly. There's no stupid bullshit that goes on. It's pretty professional for the most part. There's like a memes page for like obviously some more humor, but at the end of the day, it is here to somewhat entertain, but more or less educate and try to spread positive financial independence and the ability to trade and navigate in the financial markets. Correct. Inverse ETFs are a good option if you don't have shorting capabilities like the SPXS. Inverse ETFs are good as well. Definitely don't use inverse ETFs or leveraged ETFs for like a long time, especially like leveraged ETFs, because they do like share structure configurations quite a bit, because they like the thing with like leveraged ETFs is it'll go down much faster than it'll go up. Like, let's say an asset goes down 50%. It takes 100% to go back to its original value. And if it's leveraged 3 times, and if it's trading every day, it compounds downwards. So they always need to reverse stock split index or ETFs in order to keep the inverse ETF share at a specific price, because exchanges have to have certain share price limitations. I think it's $1 for most of them, unless you're on the OTC, obviously. But if you want to be a major instrument for larger funds and larger amounts of capital, you need to be on better exchanges. But definitely be a little cautious with leveraged ETFs. But yeah, you pick and choose what your instruments are. I like contracts for differences. For the 24-hour market exposure, opportunity, and liquidity, but that's just me. So that is my take on it. Thanks, no problem. What's that website? So this is our Discord. Let's just talk about it a little bit, because we have some people here. So this is basically our community, our ecosystem. Performante is a team of Canadian traders. We always say to start here. And we have a little description of what this Discord is, who we are, and then we have some testimonials. We've got a bunch of people here saying We do good work, basically. Check that out if you want. And then we have Performante Premium, which is our premium subscription service that allows people to know what we're trading in the cryptocurrency space. Also providing a lot of video content. We talk about, miners capitulation cycle, really going from basics. What is a trend line? How do you use TradingView? How do you use Binance? What is a pair? Like real basic bare bones stuff, all the way into the more complex tools we use to analyze the market. We also have a lot of books as well and Excel sheets that allow individuals to streamline the process to try to get to where they are able to get into the process of like a feedback loop where they understand the process of getting better. They just need to gain the experience and build like the mental characteristics of actually being a trader. Like I can tell you to be patient and to be disciplined with your risk management, but unless you feel the pain of not managing risk, you won't take me seriously. Just like if you tell a child, like, don't do this, and then he does it anyway, and then he hurts himself, and then he's like, oh shit, I shouldn't have done it. It's like a trader, same thing. I can tell people, like, you shouldn't trade, and you shouldn't risk more than, like, 3% or 2% of your account, especially if you're starting out, because you're going to have, like, 10 trades in a row that you're going to lose, or like or more, right? Or like it's a hard battle when you're starting and learning how to trade. And if you don't manage your risk, you're going to blow through your account like it's nothing. So I can tell you, you should never risk more than 1% of your account when you're just starting your live trading, like for the first time, because you're going to go through trials and tribulations when you're starting out as a trader. Every single trader does. But unless you like lose like half of your account and then you feel the excruciating pain of working hourly and then seeing that money evaporate in thin air in front of your eyes because you didn't manage risk, you are not going to learn. Everyone has to learn the hard way. I lost money starting learning the hard way. People told me manage my risk. I didn't fucking manage my risk to start. I started with like $3,000. I lost like half of it, and I was like, "Oh fuck! I need to learn this risk management thing better." And I felt the pain. It was not fun. I worked hourly for that money, and now I have to go back and work hourly again to make back the money that I lost being an idiot in the markets. And I learned my lessons through just sheer pain and progression. The really good quote from Ray Dalio. If you don't know who Ray Dalio is, he is the founder. And he's not the chief investment officer, but he's the founder of Bridgewater Associates, the largest hedge fund in the world. Super intelligent guy. He's very interesting because he's analytical, but then also he's very spiritual. Like he's very into meditation. He's calm, cool, collected in any situation. I just respect the guy immensely. But and he values family. He values like purpose and he in my opinion, great person to learn from. I've learned a lot from him. But anyways, his quote, very, very important. Pain plus reflection equals progress. And that's all it is, right? You suffer pain if you do something wrong. You look back at it. If you don't look back at it, you're not going to see any progress because you're going to go in a loop of just doing the same shit over and over again. That's just called literally being insane, expecting a different result doing the same thing. You need to look back and reflect on what you did wrong and say, okay, I didn't put a stop loss. I put way too much size on. I let my losers run. I took profits way too early. I FOMO'd in. There's so many things that you can do in a trade that is going against your overall intentions of growing an account. And you need to face those directly and just say, I fucked up and I feel the pain and now I've learned my lesson. And it's a hard pill to swallow, but the faster you understand that every single thing you do in the markets is 100% your responsibility, and there's no one you can dish that out to. You are your greatest asset and also your greatest liability. If your head is not on straight that morning and you come into the markets with a negative attitude, you're probably going to lose money. And if you're coming into it in a negative, angry attitude because you had negative discussion, an argument, a fight with someone, a significant other or whatever, you are probably going to trade on tilt. You're probably going to trade aggressive. You're probably going to put on too much size and you're going to overtrade. You're going to trade aggressive and it's probably going to lose your money. So understanding yourself, being aware of what mindset you are going into the markets is super important. All right. Let's go on to this. A little bit of rambly, but I don't mind because I never really got this, like asking a consistent trader, like psychological questions is something that I didn't really get to do too much, and I had to learn just through a lot of pain, a lot of not fun times, being very hard on my psychology for a while. And at a certain point, you crack and you just say, "Fuck it, this is enough," and you gotta you either quit or you change. There's a breaking point in humans, right? And a lot of people quit, and then those who are able to get past it get themselves up after 50 punches in the face and just say, "You can punch me all you want, I'm never gonna leave this ever." Like, you gotta have that mentality. And it's really challenging at the beginning, because it just feels like you're not doing anything right, and it literally feels like you are getting punched in the face every single day, and you still have to get up every day and try to learn, try to get better, try to learn something from the previous mistake, and you inevitably get better. It's a slow process, but that's how you get better at anything. Do not ever give up. Practice every single day. Stay consistent. Spending an hour a day at something is better than spending 16 hours 1 month, 1 day a month doing something. So stay consistent, work on it every single day, and you'll inevitably get there. All right. Also, what are your thoughts on the upcoming Bitcoin fork? Do you mean the BTC halving? Probably. So there is on May 14th, 15th, I don't exactly know. Somewhere around there. It's not by date, it's by number of blocks. 210,000 blocks. But anyways, there is a BTC halving coming up. So what does this mean? We actually made a video about this really recently, but what does this mean for BTC? This means that every 10 minutes there is a reward given to miners. Right? Simple. If you don't know anything about blockchain, look it up. And this reward is now getting cut in half. So all the miners that are currently in the market mining, their revenue is coming from this pool of BTC that is getting distributed to the miners. After the halving, this revenue stream for the miners is going to get cut in half, because there's now half as much of a reward for really the same amount of work. So, in my opinion, at the start, it's going to be deflationary, and it's going to be actually bearish for BTC because of miner capitulation. And we have a great video on mining capitulation and the cyclical patterns of miners within our most recent video. So we can see right here, this is the video that we made recently. It's called Understanding Bitcoin's Correlation with Other Assets. And we made it 4 hours ago, and we talk about the miner capitulation cycle and what we're expecting and why we're bearish on it. We also see another one which we made right here, Bitcoin mining profitability indicator explained. So these two videos will give you an understanding as to what the mining capitulation cycle is, why we're bearish on it short term because of the increased supply. Miners are going out of business because it's unprofitable. The cost of mining Bitcoin is more than the reward of selling that asset that you mine. So each time you mine Bitcoin, you lose money in a lot of these mining operations. And this is an indicator right here that actually shows it very well. So right now, it costs around $7,900 to mine 1 Bitcoin. Right now, right? On average, compared to all the different miners and operations, that's the average cost to mine operation in total. Rent, employees, energy, cost of accounting, everything put together, it's around $79.40 for 1 Bitcoin, right? And the current price of 1 Bitcoin is $7,300. So let's say you mine Bitcoin at $7,900 and you can sell it for $7,300. You're losing money each Bitcoin you sell, so it's unprofitable. And this is an average. So the only miners that are profitable right now are the most efficient miners. So this means while right now we're seeing price appreciation, that's great for the miners who are still unprofitable because they're hoping to see that price move above the average cost of the total operation, which then they're actually able to store BTC in their treasuries. But right now, the average miner who is mining Bitcoin at $7,900 per BTC is having to dip into their treasuries and dump more supply into the market to continue operations, to pay for their electricity bill, to pay for their employees, their rent, and whatever else they have for their expenses. This is why I'm bearish. So I think we're going to have another capitulation, and we can see back in 2018 we had a similar thing. We don't see the hash rate drop enough yet. We don't see the electricity cost drop enough yet. So in my personal view, the capitulation has not taken place yet fully, and after the BTC halving, we will see complete capitulation where the revenues for these mining operations get reduced by half, squeezing the inefficient miners out of the market, leaving the BTC rewards only to the most efficient miners. And then we will see a massive upward swing because now we have no more supply. All the inefficient miners have left the market. They've dumped all their BTC into the market, which I think will happen within the next push to the downside. Once that occurs, then we have a very limited amount of supply because all the people who had the supply, aka the inefficient miners, are left. The only people that are left are going to be the efficient miners that have a good store of BTC treasuries and are able to stay afloat during this difficult time for most miners. And that's basically kind of the longer term macro outlook that we have for BTC. A lot of things to say, but hopefully that gave you some understanding of what we're going to see. And once we see that last push to the downside, I think we're probably going to hit maybe 47, 5K again, maybe even lower. We don't exactly know. But look at what happened here. This is another mining capitulation when we broke below 6K in 2018, right? We saw the first push down, not a huge drop in the total cost to actually operate or the electrical cost. And then we saw a secondary capitulation that substantially dropped the total cost to operate a Bitcoin mining operation, as well as the total cost of energy to actually operate as well. And we haven't seen that second wave yet. We haven't seen the hash rate drop significantly to allow an easier level of difficulty to actually mine BTC. So that's what we're going to be looking for. So that's going to be the completion of the global macro update. We did touch on cryptocurrencies a little bit more, but hey, this is still a part of the global macro aspect in my view because it does play a role in what we could be seeing for some massive moves in the future. So thank you very much for watching our live here on TikTok as well as YouTube. And until next time, we hope you have a good one.